Well, good day and welcome to the Rock Advisors webinar. Today's apartment topic is how to reposition an apartment building for the 21st century. Perhaps you're trying to figure out a way to raise the rent or perhaps convert a property from a Class C to a Class B or a Class A. In that case, you've come to the right place. I'm Jim Dimanis and I'm the COO of the Rock Advisors. Very happy today to have a distinguished guest whom you'll well know, Derek Lobo, CEO of Rock Advisors. Good,
Hi, Jim.
good day, Derek. How are you?
Hi. Good, man. Good.
Good. Well, you can't discuss the market or even repositioning a building without a history lesson in rent controls, and who better to give us that brief lesson than you?
Well, Jim, the rent controls have defined the way the business is run in Ontario. It's had a big impact on our culture and on the psyche of landlords and tenants here. So let me just give you a very quick history of rent controls, okay? So prior to 1975, there was no rent control legislation in Ontario. It's just a regular market like, most of North America is. Landlords charged whatever rent they wanted, tenants paid that rent, and it was the market rent, and the market controlled the rent. Back in 1975, the government first introduced rent controls, and it was supposed to be a temporary piece of legislation, just during a 2-year period, and then it would be taken away. Sort of just like they brought in income tax after World War I, right?
Right.
Just sort of never got rid of it.
Exactly.
Anyways, so they brought this piece of rent control legislation, and every year there was a statutory guideline, okay? And the statutory guideline was, a number the government calculated how much a landlord could raise their rent.
Right.
And then if they had extraordinary operating costs or do capital expenditure work, they could go and make an application to the Rental Housing Tribunal to get an increase on top of that statutory guideline. I think everybody knows that. But the problem with this rent control legislation was that as long as a tenant stayed put, there's nothing you could do about raising the rent more than the guideline or making an application or rent review. The market never determined the rent. So from 1975 right through till 1998, the unit was controlled. So if you think of an apartment building with 100 boxes or 100 apartments there, it didn't matter whether the tenant moved out of apartment 101 5 or 10 times. The rent was just controlled based on the box, right?
Right.
And so the problem was, as time went on, rents fell more and more behind what the market rent was because the guideline just didn't keep up with inflation in the market and things like that. So landlords didn't have much of an incentive to renovate their buildings because they were always full and vacancy rates were very, very low. So why would you fix up an apartment building if you couldn't raise the rents, right?
Doesn't make sense.
You provided basic standards. Yeah, you provided basic standards, but the buildings got older and older and older. Finally, in 1998, they changed the legislation where instead of controlling the unit, the tenant was controlled. So now if there's a tenant living in apartment 101, and his rent was $1,000, but let's say the market rent was $1,200. Well, in the old days when he moved out, you could just charge the new guy $1,000, right? Now, you could charge the tenant the higher amount, so you could charge him $1,200, right? So now the landlord has some incentive to fix up the unit.
So it's a step in the right direction.
Right. It was called vacancy decontrol, meaning once the apartment was vacant, the landlord could charge the rent that the market dictated. But then the tenant was brought under rent control again, so it's called vacancy decontrol, recontrol. Fair enough? And that leads us to sort of how you raise rents in Ontario today.
Yeah.
So if you've got a sitting tenant living in an apartment building, then whatever rent he's paying right now, you're pretty much stuck with that. And you can get the statutory guideline on top of that, and if you make an application to rent review, you can get additional rent increases, but that only comes with spending money on capital expenditures and things like that, right? But now if that tenant moves and the new tenant moves in, you can charge whatever the market will bear, right? So if I went back to that previous example, the old tenant is paying $1,000. The new tenant should come and fix up the apartment, and he's paying $1,200. Well, that's an increase in the value of the building. Now the problem is, if you fix up the inside of the apartment, but you don't fix up the lobby and you don't fix up the hallway, well, your rents are only going to be $1,200. But if you fix up the outside of the building, the lobby, the hallways, and the apartment, and some amenity space, maybe rents could go to $1,400, right? So that's the way that rents in Ontario are raised. They're raised when a tenant moves out. You can go to the market, and that now motivates the landlord to fix up that unit because now he can raise the rent on move. So that's where we are today. We have vacancy decontrol in Ontario.
And Derek,
and I think that's,
Derek, do you think that Does most of the industry understand this? Do most landlords really get the way this system works?
Well, I think they do, because it's been in place since 1998. So, 5, 6 years that we've had this in place. But it becomes particularly opportunistic when a landlord is buying an apartment building and there's lots of rents that are below the market and there are long-term residents sitting there. When they move, the landlord has the opportunity to go in and renovate that apartment significantly, spend significant amounts of money to renew, do a new bathroom, do a new kitchen, do new flooring, put in new windows and things like that, and he can then raise that rent to the market, right?
Sure.
So, yeah, people understand vacancy decontrol, but it is something that allows an owner to create value in an older and a well-located building. Yeah.
Right.
So I just said, our philosophy is, how do you renovate a building? Well, we think you should renovate it from street to suite. So
sounds good.
An example, Jim. In that building. So if you got an old, 1960s building, really hasn't been renovated, and a tenant moves out, and you go in and do everything you can inside the apartment, and the apartment's as brand new as you can make it, yeah, but your curb appeal is still bad, right? And your lobby is still bad, your hallways are still bad. So we tell landlords, you got to fix up your building from street to suite. You kind of start at the curb and you finish in the kitchen, right? So that's the philosophy for how you renovate an apartment building.
That makes sense. And now energy management, and this is a huge factor, not only insofar as reducing our expenses and by extension the tenants' expenses, but also in just becoming responsible stewards of very important resources. So maybe you could talk a little bit about how we reduce our energy costs.
Yeah. I mean, energy management is important on several fronts. But from a straight, just cash return standpoint, if a landlord can, put in energy efficient ideas, like low wattage light bulbs,
sure.
Water conservation, things like that. Well, you sort of get two benefits from it. Number one, your operating cost goes down, right? So if your operating cost goes down, then your net operating income goes up, right?
Right.
And you're increasing the value of your building. But the second thing is if you cut your energy costs, you can also make if you spend money to renovate your building, you can also make an application to the tribunal to raise the rents based on that capital expenditure. So if you put in all new windows and you do a water retrofit and electrical retrofit, you're going to save money on your utility costs, right? So that's going to increase the value of your building. But you can also make an application to rent review and get some of that cost of doing those renovations passed through onto the rents. That's a topic for another day, right?
Sure.
It's fairly complex, that whole rent review process. But the thing about doing energy retrofit work is you get sort of two benefits to it. Okay, three benefits to it. Number one, you're just a wise steward of the resources of the planet, right? Number two, you cut your energy costs, so your net operating income goes up. And three is you can make an application to rent review to raise the rents based on those costs. Okay?
Can you talk?
I need some help and some advice in that area, but
sure,
that's the philosophy.
So I'm glad you mentioned water, because I think that's a big one that's happening right now, and it's going to become more important to landlords and investors moving forward. But also smart metering. Can you just talk a little bit about that?
Yes, smart metering is a very good idea. There are a number of companies out there that do it. I think we've actually had them on as guests in previous webinars. But the whole idea about smart metering is that when a resident pays their own utility, they're going to be much more careful than when they're not.
Right.
Just that simple. I mean, think about when you go to a hotel room, you're not as sensitive about turning the lights off when you go down for dinner than you are if you're home.
I have to admit I'm guilty of that.
We all are,
yeah.
Right? And I kind of joke and say, do you ever put premium gas in a rental car? No. You kind of top it up with water, right?
Exactly.
but you sort of get the idea, right?
No, absolutely.
I mean, when you're paying for it, you're going to be more careful. So I think energy management's an important aspect for landlords to think about, and sub-metering energy is probably one of the best things you can do, or do them both, right?
Sure.
Because you don't want a gigantic utility bill coming to your residence either that's going to impact on the rent you charge.
Sure. So, look, moving forward now, I mean, demographics matter. household incomes, etc., transit, amenities, etc.
Yeah.
Where do we renovate? Where do we do this? Which apartments in Toronto, for instance? Where do we start, Derek?
Yeah, yes. So the whole premise for this webinar is, how do you renovate an apartment building, right? Well, the first thing you want to say is it's not just an apartment building, it's where is the apartment building you want to renovate. So you want to be renovating buildings in areas that are growing and that are desirable, where people want to be, as opposed to areas that are declining.
Makes sense.
Just as a simple example, right? Let's just take the City of Toronto, and let's just draw transit-oriented areas are always more desirable places to live in, generally speaking, right?
So we've got that up on the screen right now.
Right. So we've got the black line represents the subway lines and the rapid transit lines inside the City of Toronto. And then what we drew was a 1 kilometer band around them there in red. Okay?
Okay.
So let's just say you wanted to buy an apartment building near a transit-oriented area, which would be a good idea. Ideally, all things being equal, you'd like to buy in the areas where incomes are high. So all we did is we plotted a map here of the City of Toronto, the transit lines, a band around the transit lines, and then we plotted average income, which is income available from Stats Canada. So the darker the area, the higher the income. Again, all things being equal, I would want to buy an apartment building in a transit-oriented area where the color is darker, meaning that the people are generally having a higher income and they're able to pay more. So when I buy that apartment and it has rents of $1,000, I can now go ahead and renovate that building, and the people living in the area could afford the $1,400. Whereas if I did that in an area where it was very light brown, then there'd be, or beige, there'd be less and less people who could afford it because their incomes on average are lower. So there's many things to take into consideration when you're renovating a building, but one of the first, I think, is what's the area that the building is in. If it's a C building in a C area, I'm not sure it makes sense to make it into an A quality building in a C area. What you'd rather do is get an A area with a C building and obviously renovate it. So location matters, and it's something that can be studied. In our buy-side brokerage program here at Rock, we work with apartment owners who say, I want to buy an apartment building, but I want to add value. Well, the first thing we figure out is where should you buy that building and where can you add the value because you can raise the rents.
Yeah, market knowledge is clearly invaluable when you're doing this kind of work moving forward. So this is a good segue now into what to renovate in an apartment suite and rate of return. So perhaps you can expand on that.
Yeah. This was a study, first of all, done in the U.S., okay? So you got to keep that in mind. But an architect there went and he asked developers, he asked this question regarding in-suite apartments. He said, which of the following amenities provide you an acceptable rate of return and which ones do not provide an acceptable rate of return? So the orange line, the developer is saying, yes, I'm getting a good rate of return from this, okay? And so the higher the orange bar is, meaning the more desirable it is from a developer standpoint of making money. Not does this make it more livable, not do you like it, not does the tenant like it, straight hard numbers, is this getting you a better rate of return, right? Then on the opposite side of it, they plotted, if it's not giving you an acceptable rate of return, that's the line diagram, the black line diagram. So basically if you add up the orange line and the black line, it adds up to, 100%. Does that make sense, Jim?
Absolutely. Yeah, makes total sense.
So what you want to look at then is what are all the orange bars that are high? Those might be the things that you want to do in your apartment building. Okay, so number one, you see ceiling fans, right?
Yeah.
Many landlords said, yes, you get a high rate of return. It's true. I mean, how much would it cost to put a ceiling fan into a unit? $50, $100, something like that?
Yeah,
right?
Not very much.
The installation, electrical work, right. So, but all of a sudden, it's really nice to have a fan in your bedroom, when you go to sleep in the summer and things like that. Putting in a washer and dryer is a huge one. Putting in computer desks is important. Putting in additional phone lines, internet access, high-speed access. So all things that are, so you can see how developers are thinking, right? Let me put in the things that are relatively cheap that get me the most bang for the buck. Right.
Yeah,
what
makes
are things
sense.
they didn't like? What are things they didn't like? Well, look at about the 8th or 9th one in skylights. It's got the lowest return, right? Maybe everybody likes a skylight, but they leak, they're expensive to put in.
It's a maintenance hazard, really.
Right, and stuff like that. So what the listener can do is just walk through each one of these items and say, where did developers say that they got a good return, and maybe do the things that are on the orange bars and not do the things that are on the black lines that are lower. Okay? So it's been up here long enough that people can look at it, they can rewind it and just see which of the items that give them good bang for the buck. And this can be used for both renovating existing apartments and building new buildings. Right?
And that leads us into amenities.
Yeah, and so now we're talking about what you renovate in the apartment building itself. So outside the suites, what gets you a great rate of return? So that's the same question again. Which of the following amenities provides an acceptable rate of return, and which ones do not provide an acceptable rate of return? You can see that they typically have said that fitness centers give you a good rate of return. Especially, I mean, if you're doing an urban project with younger people and things like that, a fitness center is extremely important. Now you see swimming pools at a high return. Now that maybe is a lot of the U.S. influence in the southern U.S. I'm not sure that would absolutely work in Canada, but storage units have high returns. Direct entry garages have high returns. Proximity to urban, which they treat as an amenity here, right? Meaning location, right? So
right.
Control property access, so security and things like that. So many things on here that landlords say give us a good rate of return, but there are many things on like saunas, racquetball courts, and things like that. They're saying don't give us a good rate of return.
Sure. And the reality too, Derek, is that the market is becoming a lot more competitive, and if you want to compete, you really have to take all of this into consideration and make the right business decision.
Right. And you've got a limited amount of money to renovate the building. What should you do? Right. So we talked about energy retrofit earlier, right? But that doesn't really show up in the sizzle in the building. Right. That's a good business decision you make to cut your operating costs and things like that. This stuff here is the sizzle on the steak that the resident's going to see when they walk into your building, or they're going to be features and benefits that they want in the building. So,
Derek, how does this compare to condos, for instance? You talk about amenities in apartments versus condos. Maybe you can just talk a little bit about that.
Yeah, when we're talking to developers, now this is mainly about building an apartment building, right? Many condo developers want to build purpose-built rental apartments, and what I say to them is, and they're quite surprised by it, is that you need more amenities and sizzle in an apartment building than you need in a condo. Because in a condo building, you're selling the sizzle on the steak. In a
the
condo,
sizzle on the steak.
The steak.
Love
yeah,
it.
I mean,
I love
this is the short-term. This is a short-term agreement you're making with the residents, 12 months, right?
Right.
It's not one night in the hotel, but I'm not buying this thing either forever, right? So I don't like it. I'll move after 12 months. When I'm buying a condominium, I'm much more pragmatic in my decision-making process. If I see a pool there, if I see, all kinds of expensive amenities, I'm thinking, whoa, I've got to pay for this, my maintenance fee. As a renter, it's built into my rent. So it's just different the way you think about an apartment versus a condo.
Yeah, no, that's great information. Thanks, thank you very much, Derek. And for our listeners, if you're looking for more information, please don't hesitate to contact Derek or myself. Derek, I'd like you to hang around. We can talk a little bit about the sales in just a couple of seconds here. Just wanted to say that we've got some great topics coming up. September 25th, how to effectively sell an apartment building in a tight market. And then moving forward to November 22nd, this is going to be a favorite of mine, and that's finding and negotiating your best equity deal. Here at ROC, we're always looking for good people to co-broker with. If you are interested, please don't hesitate to contact Daryl McCullough, who is our broker of record. His information is there. And thanks again to the good folks at RealTrack for the following sales information. So here we are, 292 number of sales. Average price per unit holding steady north of 100,000 at 119,507. Largest transaction, 28 million, and that was in Waterloo. Transactions here, not much of a surprise. 52% in the GTA. Okay, let's get to it. Here we go. Diplomat Apartments in Streetsville. I don't have much to say about this one. Seems like a pretty straightforward deal. Derek, anything on your end?
Yeah. Well, I think if you know Streetsville, it's a really nicely gentrified area. It's the kind of place where you could kind of, walk from your apartment to some nice coffee shops and restaurants and things like that. So I think that, this would be a good building to reposition given its location. I would suspect that the income in this kind of cool area of Mississauga is pretty high. It's a pretty good price, $166 per unit.
Okay. Wow. 310 Lonsdale Road. This is an unbelievable price. 17 units, and it looks like these can be renovated and rents dramatically increased as well. So good value here, Derek?
Yeah, it's the area here that's driving the rent, right? That's an old, probably 1920, so 1924 they're built in 1924. There's probably some land value here, but certainly Lonsdale is one of the finest areas, in the city. and you would be probably gutting those apartments and renovating them. Same thing right here. This is the next door building, right? So
sister building,
it's 34 units in 34 units in total. Also, I would argue that maybe down the road the land play for those two buildings might be quite valuable also.
Oh, here's another good location, 587 Avenue Road. So again, sounds like, or it looks like another building where you may want to renovate the units, increase the rent.
Yeah, exactly. All the stuff that we talked about, a little earlier, Jim, would probably apply to these buildings. And these are kind of buildings where, because the area is so strong, you'd spend a lot of money on that.
You bet. Okay, Forest View Apartments. This is in North York, 100K, 123,000. Looks like it's a traditional sale. Anything to offer on this?
Yeah, looks like a typical deal, right? I mean, that's the kind of prices that these sort of, mid-market buildings are selling in suburban areas. And, Bathurst Street, there's some pretty good parts of Bathurst Street also. Sure.
Oh, Oshawa. So we're approaching the $100,000 mark. Looks like a reasonable price per square foot on this.
Yeah, but even you think about it, $90,000 per unit in Oshawa is a pretty good number. But it looks like a nice little building. Smaller buildings, we've talked about this often before, tend not to sell on a cap rate basis, right? They sell on a price per unit basis. The buyer maybe a smaller owner who just wants to own a building, right? Sure.
Now this looks familiar. I'm sure you can talk to this. I mean, this is a rock deal.
Yeah, there's a few of them here, right? We've got a couple. Just go through them.
Chatham Towers. We've got the Regal Towers and Riverview Park and Thames Park Towers.
You can see all the four buildings. So you can see there's a wide range of prices. They range. You have to go back one. They range anywhere from $50,000 to $113,000 per unit. Chatham is a town that's had its economic problems. But this was a nice portfolio, 350 units owned by the family for a long time. But you can certainly see just keep going forward, Jim, the variation in prices that are there. And this year was the best building. And so the prices varied, but the average price was probably in around $70,000 per unit. Chatham is one of the places where you can still buy an apartment building, by the pound.
Okay, and this brings us to Waterloo.
This was a student housing deal, and you can see here that that it was $73,000 per bed. We just went to Chatham where it was $70,000 per unit, right?
Right.
Here you're talking about so you're probably talking on the 4 and 5 bedroom units. So you're talking about $400,000 per unit, and that's typical for brand new student housing construction.
What kind of rents per square foot would an investor be looking at with something like this?
This is the student housing price per square foot is going to be a good 30-40% higher than a traditional apartment building that's across the road.
And for our listeners, Rock specializes in student housing.
Well, we've done about $300 million in student housing transactions over the years. Yeah.
Sure. Okay. Manhattan Court in Guelph looks like a plain Jane building.
Yeah, but still, bringing in, $112,000 per unit. I think, if you look at the rents down there, the 3 bedrooms are $1,000, right? So $1,075. Not huge rents, but maybe there's some upside there also.
And this one on Albert Street, this is in Ottawa, one of my favorite cities. Small buildings in Ottawa getting high prices, $150,000 per unit.
Yeah, that's a big number. But if you look, this is it's in the downtown core at Kent and Albert Street. The 3 bedroom, there's only one of them. It's getting $1,800 per month. And this is a reflection of, again, location drives value. And we're always saying, A areas are getting top prices, but C buildings and C areas just haven't had the run-up in price and things like that. So this is driven by location. $150,000 per unit is a big number.
Roehampton Place. Now this brings us to the Niagara market, and again, still getting some reasonable value here, $95,000 per unit.
Yeah. It's interesting that once you go out from Toronto, especially in Niagara, and when you get down to Windsor and Chatham and places like that, you're still getting reasonable value. You're probably getting a decent cap rate on these buildings, and the price per pound is reasonable. But clearly, this building, if it were in Toronto, is $150,000 or $160,000 per unit.
Mm-hmm. And here we are in Hamilton, again, by the pound. You can still get good value in Hamilton.
Yeah. I think Hamilton prices are Because I think people believe, rightly or wrong, I'm not sure, but the growth in Hamilton in rent is not that high. So if this building exists in a great area in Toronto, you pay $120,000 for an afford, but you could go and renovate it and dramatically raise the rents. In Hamilton here, you may not be able to dramatically raise the rents.
And here we are again.
Another building in Hamilton,
yep.
Yeah, $75,000 per unit.
Same kind of thing. Well, thank you so much, Derek. It's always a pleasure. And for our listeners, thank you for joining us. Please do visit us on our website at rockaptadvisors.ca, where you can see our 2013 webinar schedule. And please don't hesitate to send us an email with any kind of feedback, or if there's a topic that you'd like us to speak to, we'd certainly be pleased to hear from you. Thank you and enjoy the day.